So the virus really has pulled the tide out and exposed a lot of uh, companies that have been doing very well and may continue to do very well, and companies that really are going to struggle going forward. So, Mike, let's take a look at the divergence in the S&P 500 index of what we call the haves versus the have-nots, meaning the stocks that have really done well during this and the stocks that really have not done well at all.
If you look at the S&P 500 index, just the index in its totality, you're down about 10% year to date, and went down 34% during the drawdown period, up 30% from the bottom. It looks like a V. But if you start, checking under the hood and peeling back the layers, you can see there are some companies in the S&P 500 that have totally detached in a positive way, the haves, if you will. These companies, their business models have actually benefited, if anything, from this crisis, and they're expected to grow earnings and revenues through this crisis. And it's sort of the strong getting stronger, the rich getting richer. So there's that segment of stocks that, definitely look like they're having a V-shaped recovery, or it looks like this actually never happened to them. And then, there's certainly the other side of the equation, sort of the have-nots, the companies that, after being beaten down significantly during the COVID-19 drawdown, they haven't really experienced any recovery whatsoever, and their business models have been severely impacted by the crisis, and have to totally reorganize, what they're doing and think about how they're going to survive. So we've created indices to represent each of these types of companies. So the blue line here shows the year-to-date growth of $100 for the haves index, a group of 15 companies that have sort of benefited from this. And if you started out the year with $100, you'd have 116. So really, not much of a drawdown whatsoever for these companies compared to the broad index, the S&P 500. You started the year with 100, you now have 92, so you're only down about 8%. And then the have-nots index, which this is where this red line looks a lot more like an L than a V. These companies, if you put $100 into them at the beginning of the year, you'd be down to 42. So just a huge divergence under the surface.
So let's take a look at the worst hit first. So the have-nots, and go through some of these companies. Some of them are very obvious, but go ahead and walk us through this chart.
Basically, what we did was we took the S&P 500 and we looked at all the companies. We looked at the business models of all the companies that had been beaten down the most. Their earnings seem to be most heavily impacted. Their sales projections have come down the most. And you can come up with a group of 15 stocks. What we have represented here are some of the large airline companies. In the consumer space, you see some cruise lines. You see Darden Restaurants, which is a big restaurant chain, Macy's, so a lot of retailers, brick and mortar retail, and then companies involved in leisure, hospitality, lodging, so things like Host Hotels and Resorts, and then Simon Property Group, which is the biggest mall REIT. And you think about all these companies' business models, and they, might have been changed forever based on this COVID-19 crisis. And you look at how they've performed on average. They're 64% below their 52-week high. So just nowhere near it. Their year-over-year sales growth expected to decline 63%, and their year-over-year earnings are expected to decline 311%. So just severely impacted, and they're cheap. That's, the silver lining is they do look very cheap. They're trading at 1.4 times forward sales estimates, and those sales estimates have come down a lot. So they look much cheaper than the overall market.
Right. So that's probably an obvious list for most of the viewers, that they would recognize a lot of those names and expect that. So let's turn to the folks who really are the haves and have done well during this.
Yeah, a lot of these are essential businesses that have been able to stay open. And already had business models that relied on, things like order pickup, very delivery heavy. So, some of the names that pop off the chart: Amazon, obviously has done very well, navigated this crisis well. Their business model was set up for that. So they're expected to grow sales by about 26% year over year. And that's a very high number, the year over year comparison. I mean, you're talking about a lot of sales for Amazon. It's a huge company. So that's just extremely impressive. Chipotle Mexican Grill, what they've been able to do through their order delivery and order pickup, they've navigated the crisis very well. Things like Home Depot, deemed an essential business, they were allowed to stay open. And we know with folks staying home, there's been a lot of nesting going on and a lot of home renovations, as you can probably tell by the updates to my office over time. But then other things like essential food services, Conagra Brands, the Clorox company for obvious reasons, disinfectant wipes, Costco, 3M, which is one of the largest PPE suppliers. And then some tech companies that, their business models have been resilient. Things like Electronic Arts. A lot of folks are turning to video gaming during this time when they're at home. Netflix, PayPal, and so these companies in aggregate are only 5% away from their all-time high. And a lot of their all-time highs were the S&P 500's all-time high, which was February 19th. So basically, what that means is for the year-to-date period, almost all of these companies are firmly positive, made money. And year over year sales expected to grow at 9% clip. You think about growing your sales at 9% when in Q2 economic growth is supposed to decline 26%, really bucking the trend and detaching from what's really going on in the economy. And the bad news of these stocks is, on average, they're trading at 4.4 times forward sales, which is extremely rich. The S&P 500 right now is trading at 2 times forward sales, thereabouts, and 22 times forward earnings. So basically, these companies in aggregate are more than twice as expensive as the overall market. Another way to utilize this information, looking at the difference in performance between the haves and have-nots, is, if you start to see that have-nots index start to rally, the market contains a lot of great leading information about the economy and about these businesses. And so if you start to see the stock prices of those have-not companies rally, that can be a really strong leading indicator that the economy is coming back and we're getting a control over this virus. So definitely want to see those companies come back for sure.
In future segments, one of the things we want to tackle is just the whole philosophy behind the massive increase in debt and whether deficit spending actually helps an economic rebound, and or what other consequences, intended or unintended, will we be faced with.
A big question is, how are we going to pay for all of this fiscal stimulus? And, are we going to pay for it ever? Do we ever have to pay for it? Is the Fed paying for it? Will any of this result in inflation? When's the point of no return? When is the U.S.'s fiscal situation so out of hand that there are actually repercussions? So exploring, a lot of big ideas, and they all have profound implications for investment strategy going forward. So those are all things we'll look into.
Mike, thanks for sharing your thoughts today on these topics and for previewing some of the upcoming topics. We'll look forward to those. And thanks all of you for viewing, and we'll look forward to talking with you soon.